Alright, so in this lesson we're going to go ahead and cover types of orders, and there are many different order types which I will go ahead and cover in this lesson. So the first order type, and certainly the most straightforward, is a market order. So a market order is an order placed at the market and is executed instantly at the best available price. If the euro-dollar pair was trading at a 1.0810 bid and a 1.0815 ask, if you were to buy the pair placing a market order, your buy order would be executed at the best price available, but would most likely be closer to the ask price of 1.0815. On the other hand, if you were to sell a position using a market order, your sell order would most likely be executed closer to the bid at 1.0815. So let's go ahead and look at an example here. And one thing that you'll notice is this is kind of a new platform that we're looking at here, and I'm just using this quick account that I set up on TradeKing as opposed to TradingView, because this conveys the information a little bit better than it does on TradingView. So as you noticed, there's numerous orders here, which I'll go ahead and cover, but focusing on a market order here. So you'll notice on this trade order screen, you can of course select which currency pair you want to trade. Here we've selected the euro-dollar pair. You can also select whether you want to buy or sell the pair. You can select the amount that you want to trade. We'll stick with the smallest amount, 1,000 units. And then what you can notice is you're unable to change the price at which your order is executed at. So that is in fact because this is a market order, where the order, once you hit submit order, this order is placed at the market and is executed instantly at the best available price. So that's one of the advantages of a market order, is your order will be executed instantly. But on the other hand, if you were to enter this order without setting a price, in theory, the currency pair price could spike up from some sort of event, and then you would, pay a lot more than you were hoping for. So that being said, to avoid that disadvantage, that is in fact where the next type of order comes into play. So a limit order, and a limit order is an order placed to buy or sell at a specified price or better. And because you are setting a price, limit orders ensure you do not pay more than you are willing to. So let's go ahead here and look at an example, because I think this is definitely helpful to look at. So we'll just stick to the same currency pair and amount throughout these examples, but we'll change to our order type. So as you can notice, that changed a little bit. A couple more things popped up. So here you can see this is a limit order. You are able to change the rate. So this updates according to the current rate. Let's say you think prices might go down over the next hour or so, and you think this current price is a little expensive, so you can either hit this and lower the price, or you can just type in and say, I don't want to pay more than 1.1100 for the euro-dollar pair, and therefore as soon as prices dip down and hit this level, that is when your buy order will go into place. And then I'll show one more use of a limit order, which is, let's say you already own 1,000 units of the euro-dollar pair. So in that case, you can say I bought the euro-dollar pair 2 days ago, and it's since gone up in price, and unfortunately I'll be away from my computer during the rest of the day, but I think it'll reach 1.2100 within a couple hours. Therefore, the euro-dollar pair which you already own will be sold automatically once you hit submit. Once you submit this limit order, your order will be executed at this price that you input. So that is a limit order, and then the next type of order we'll cover is a stop loss order. And again, I'm sure if you've been trading stocks, equities, I'm sure that you're familiar with the majority of these order types. So a stop loss is an order placed to sell at a certain price. A stop loss order is meant to limit a trader's loss on a position. For example, if you were to go long euro-dollar at 1.1025, you can place a 15 pip or a 10 pip or a 30 pip stop loss order, and for this example I have a 15 pip stop loss order at 1.1010, where your position will be liquidated if the price moves down to 1.1010. Stop losses are important in Forex trading because it gives you the ability to control risk and limit potential losses. So again, I'll pull up our order screen so we can look at an example. So here it is, a stop loss order, just says stop in this case. But so let's say you've already bought the euro-dollar pair, you own the euro-dollar pair, you own 1,000 units of it. When you come to the stop loss order screen, obviously it's going to be a sell order. As you can see, it is a stop order here. And then, let's say, you're uncomfortable with the losses you would amount if, the euro-dollar pair were to go below these levels. So, that's kind of your form of risk management. You're limiting your downside losses, where if you were to hit submit order, your current position in the euro-dollar would be sold if prices were to go below this level. Alright, and so the next type of order that we'll cover is a trailing stop loss, which is connected to a trade like a stop loss, but as the name implies, it trails the current market price as your trade moves in your favor. So I think the best way to depict this is definitely through an example. So let's go back to our order screen here. So really you can think of a trailing stop like a ladder. So in this case, we set a fairly tight trailing stop. Essentially the use for this is if you believe there's upside in a currency, but you want to capture that upside, but on the way up you don't want to give back too much of your unrealized gains. So essentially, as the currency price goes up, that's your stop loss will trail that price. So essentially, as the price goes up, so does your stop loss order. And of course, you can adjust the how tight that is, depending on your risk preferences. And so the next type of order is a one cancels the other, or OCO for short. And an OCO order is a pair of orders where if one order is executed, the other is canceled. So for example, if the euro dollar is trading at 1.1000 and you either want to buy at 1.1050 in anticipation of a breakout or initiate a selling position if the pair falls below 1.0080, so then a buy order will be triggered if 1.1050 is reached while simultaneously canceling the sell order. The opposite is also true, where the sell order will be triggered if 1.0080 is reached while simultaneously canceling the buy order. So for that, let's definitely go ahead and look at an example. So here we go. One cancels the other, OCO. So this screen is what it shows is, and let me try and match this up with our example. So let's say you're buy 1,000 units, sell 1,000 units. This would be a sell, and then in our example we had a rate of buy at 1.1050, and then our sell price would be 1.0080. So essentially what this would do, you currently don't have a position, so you're flat. So so if the currency price, the euro dollar price, were to, and I should change this to there we go. So so essentially, if the currency price reaches this price, and this is a limit order, this will execute a buy order of 1,000 units. And if that happens, then this sell order will be canceled. And then the opposite is also true, where this is also a limit order. So if the euro dollar pair were to hit these levels, you would essentially be short the euro dollar, and this order would be executed while this order would be canceled. And then the next order I wanted to discuss is a one triggers the other, or OTO for short, or also known as an if-then order, which allows you to simultaneously place a second order that is contingent on the fill of the first order. An OTO order is useful if you will be away from your computer. So for example, if the euro dollar is trading at 1.1000 and you believe if the pair appreciates to 1.1050, it will reverse course back to 1.1000. To capture this trade, you can set an OTO order to sell euro dollar at 1.1050 while simultaneously placing a buy limit order at 1.1000. The OTO order will only be triggered if euro dollar hits 1.1050. So let's look at an example of what this looks like. So this is going to be an if-then order. So really, so this is set up pretty well. So this is a limit order. So essentially what this does is, if the euro dollar price reaches this price, a buy order will be executed, while simultaneously a stop loss sell order will be placed at a level below that pair, effectively protecting your downside. So essentially, this is kind of a safe thing to do. Anytime you buy a currency pair, it is safe to at the same time add a stop loss, just so you have that added protection. And then I wanted to discuss good till canceled orders, or GTC for short, as well as good for the day orders, also GFD for short. And both of these orders are fairly self-explanatory, as a good till canceled order will not expire until you manually cancel it. So be careful when you set these so that you do not forget about them. And a good for the day order remains active until the end of the trading day, which is 5 p.m. Eastern Standard Time, although this may vary depending on your broker, so make sure you always double check. And then going back to our platform, you'll see in this upper right hand corner you have the end of day order and the good till canceled order. And also, depending on your broker, some may call these good for the day order, end of day order, so the terminology might be different, but it's all the same. Alright, so those are the types of orders, and definitely go back, review each of those, and also see if you can kind of apply those in a demo account. It's definitely good practice. Alright, so those are the types of orders, and definitely go back and review if you need to, and looking forward to the next lesson.